Katie Stockton is here to talk about what could happen. We're really fascinated by bonds and interest rates. So we want to get to that in a second to see, because you did think we were in an uptrend for rates. But first, let's talk what our viewers care most about. Equities are kind of in a, is it a malaise? Is it a downtrend? Is it a correction? Seasonally, it's a weak time. Is it anything worse than what we should have expected?
No, not at this stage. So we have a correction within a cyclical uptrend at this point. Below 4,200, if we saw that support area taken out,
the S&P,
it would start to look like something worse, because the next support is around 3,900. But we do expect the correction to mature, and honestly, even as early as next week. The seasonal influences, as you know, are really weak in September. We have usually a much better October, November. I think the bigger question beyond a potential relief rally is how sustainable that is, and will it get us back above that long-term resistance, which is about 4,600.
I don't know which. I think all months have Ides, I think, around the teens, like 13th, 14th, 15th. The Ides of October, they just are bad. They're not bad. They're good because there's been so many bottoms, but they can be very frightening bottoms that occur in October over the years.
Yeah,
something like that.
Little washouts, right?
And why does it happen in October? Halloween?
It must be Halloween, very spooky. There is a Friday the 13th, I think, this one too. So who knows? But what I will say is that the sentiment is already somewhat washed out. I mean, we're not at 0% for the fear and greed index, but we did hit 25%. Which shows that bearishness has certainly increased, obviously driven in part by Treasury yields. We also have very oversold extremes in market breadth, so that creates a backdrop in which the market, it's easier for it to go higher. So you have the combination of support nearby, oversold readings into the corrective phase, which is now played out as that kind of ABC correction. And with the sentiment backdrop better, it should release it to at least see some relief this coming month.
We should get used to whatever the S&P is doing, the NASDAQ does more easily.
The high beta, yeah.
High beta.
So consolidation in relative terms, but we would
Dow
expect
less probably.
I think technology should outperform as one. Former leadership in general should outperform on the back of this corrective phase. I think we'll see a shift right back to the mega caps, but also we should see breadth improve off that oversold reading. So maybe the small cap benchmarks do a little bit better, or at least some kind of retracement. Anyone
thought we were near a high on the 10-year at 4%? That they're all gone. So now we don't know where the high is.
Remember, we were talking about 5 1/4, and everybody thought I was crazy.
5 1/4
doesn't feel that far anymore,
right.
Does it?
No. Is that the high?
That is the next resistance for the 10-year yield.
And what's the resistance after that?
Oh goodness, I'm not even going to put out that number because I don't want to be held to it.
You don't need. I don't want it to come out of your mouth.
Exactly.
Whatever that number is.
I don't want to upset people. It's Friday.
5 1/4.
What is it? She's not. It's in the sixes. So right. So that
and must be 666 maybe.
It doesn't mean it's a magnet by any stretch. That's not the nature of resistance. It's just the next hurdle on the chart. So this 5 1/4 though holds importance. It's the highs from 2006-07. And when we look at a Treasury bond benchmark like a TLT, you certainly have a breakdown. That breakdown should be confirmed today. And yet there is still support. So if you go back to about 2009 on TLT, there's support around 87.5. So we feel that while we have a breakout in yields, a breakdown in TLT and the likes, that we will see consolidation for probably a couple of months. And that could also help the equity market recover to some degree.
But you don't know where after that.
And the jury is out on the long term.
Bonds. You don't know where after that.
Oh, and bonds too. Well, we assume that the secular shift that we've seen in yields will maintain itself. But within that context, you can certainly see prolonged counter-trend moves. So we're looking for a counter-trend move in here very soon. That's in part based on our counter-trend measures like the DeMark indicators.
You're looking for a counter-trend that means yields will come back down?
Right. But then, sideways to lower, perhaps, yeah. And that should help equities. I mean, think about the influence on market sentiment from yields.
But we're in a totally new paradigm where it's going to be higher in general.
It seems like all of the trend following gauges, intermediate and long term, still do point higher.
Bitcoin has tested your support how many times?
For Bitcoin?
Yeah.
Oh, that 25,200 level.
Like
it's
10
still
times.
intact. Yeah, I mean, it's proven to be a very important level for it.
Yeah, it's 27
so
today.
it's holding, but it's also not breaking out.
No.
So it seems a bit indecisive when you see this kind of consolidation. And, risk on, if risk on comes back to equities, well, maybe Bitcoin can actually break out.
Katie, just really quickly, taking what you just said and trying to put it to average people who maybe are not investors playing along on all this. If you're somebody who's about to look for a mortgage, you would tell them, get the 30-year fix. Do not sign up for an adjustable rate mortgage because you could be in for a world of pain if you do.
I think so. And when you look back at the secular downtrend that preceded what we're now, in the midst of, I think it's very feasible to see them higher for longer and even potentially much higher, unfortunately, if you're talking in several years.
You can always refinance, but it's much more painful to get out of an adjustable rate if rates go up. And
I don't think patience would necessarily pay off in that case, yeah.
And you wouldn't necessarily go to put all your money in a 10-year right now either. Would you wait a while?
Well, it depends on the time horizon, right? If you can get in and out, if I could, buy treasuries right now.
No, I mean, if you're, no, you don't want to be sitting on $80 of principal value for the next, a year from now, it's worth
Fair enough,
80.
for a year, yeah.